Good afternoon, friends. Welcome to the CEC Gurukul lecture series. We are discussing about marginal costing and break-even analysis. In our discussion on marginal costing and break-even analysis, we have discussed different concepts. In my previous lecture on marginal costing and break-even analysis, I talked about break-even analysis, I talked about cost volume profit analysis, and I also discussed about break-even chart, or you can call it break-even graph. Right? Now, I am continuing with that lecture, and I am discussing some other important points or some other important aspects of the marginal costing or the break-even analysis. The one important aspect is called key factor. While making business decision making using marginal costing, you find out what is the key factor in your business. Let's find out what is key factor, what we mean by key factor. Sometime in a business, one of the factor constrains your profitability of the firm. That is, for example, what you require for production, what you require for sales. You require machine, you require labor force, you require skilled labor, you require capital, you require number of hours for which the machine can work, and so on and so forth. Out of these various factors which I have just talked about, supposing the capacity of the machine is limited, you have enough sales order, you can supply enough more and more goods, you can sell more goods if you can produce. But since the machine is limited, you have only, say for example, 10 machines, and the capacity of that 10 machine is producing 1 lakh units per month, and you have an order of 1,50,000 rupees, which you have 1,50,000 units, which you have to supply within a month. But since the capacity of the machine, you have the money, you have the resources, you have the technical know-how, you have the order, means you can make the sales. But since the capacity of the machine is maximally to produce 1 lakh units, right? So this machine capacity becomes the key factor. So while making business decision, you must take into account the key factor of the business if there is any. So the objective of business is to earn maximum profit. However, it is not always easy to achieve this objective because of the profit earning is affected by variety of factors. For example, in a business may have sufficient orders on hand, as I said, ample skilled labor and production capacity, means you have production capacity, you can produce, you have the skilled labor, you have sufficient orders, but may be unable to obtain all the quantity of material it needs for the manufacture of the maximum quantity which you could be sold. Means here in this example, the material becomes the key factor. That is, you have limited supply of material, right? So because of the scarcity of the raw material, supposing you are importing some raw material, right? So because of some reasons, you are not able to import the raw material in the quantity which you desire, right? So this material which you are importing, you are able to procure a limited quantity of material. So this material becomes the key factor. So manufacturing means, so for the manufacture of the maximum quantity which you could be sold. Thus, material is the key factor which limits the size of output and prevents any an undertaking from maximizing its profit. Means had you could procure the raw material in abundant quantity, right, you could have made more production, you could have made more sales, and you could have made more profit. But since the supply of the material is limited, the material becomes the key factor. Similarly, sometimes a business is not able to sell all that it can produce. In such a case, sales becomes the key factor, right? So a key factor is known as limiting factor or governing factor. Example of limiting factor are, it may be sales, it may be material, labor of a particular skills, means skilled labor may be a limiting factor, production capacity may be limiting factor, machine hours, financial resources, right? You have limited finance, right? So because of that, you are not able to procure material, you are not able to procure more human resource, that becomes the financial resource, becomes the key factor. So when a key factor is in operating, the most profitable position is reached where contribution per unit of key factor is maximum. See, what is the idea of studying this key factor? I would say the very idea of knowing or studying the key factor is that if you produce various products, right, and this product takes different number of hours of production, say example machine hours, you produce 3 products, machine capacity is limited. So in that case, you will produce those products where the contribution per machine hour is more. You will produce that product more. You will produce that product less where the contribution per machine hour is less, because the production capacity is limited. The machine working hours are limited. You have a limited machines, and that machines can be used for a limited number of hours. So this machine is a limiting factor. So, and if your firm produces 3 products and each of the product takes different number of machine hours, so you will produce those products more where the contribution per machine hour is more. So this is the benefit of the knowing about the key factor. So now, for example, in a case of choice between producing product A, which yields a contribution of rupees 15 per unit, and product B, which yields a contribution of 20 per unit, that is, product A is giving you contribution of 15 rupees, product B is giving you a contribution of 20 rupees. So obviously the product B is more profitable. If, however, product A takes 3 kg of material, which is a limiting factor. Here in our example, material is a limiting factor. So product A takes 3 kg of material and product B takes 5 kg of, means product B requires 5 kg of material, product A requires 3 kg of material. The respective contribution per kg of material will be, means because the total contribution of product A is 15 rupees. So 15 divided by 3, because product A takes 3 kg of material, that is rupees 5. And for machine B, which gives you 20 rupees contribution in total, and it requires 5 kg of material, right? So the contribution is 20 divided by 5, that is rupees 4. So hence product A would be more profitable, keeping in view the limiting factor. See, in this example, what you have noticed is product A is giving you 15 rupees contribution, product B is giving you 20 rupees contribution. But if the material supply is limited, you will see that which product is giving you more contribution per kg of the material, right? So since product A requires 3 kg, so the contribution is rupees 5 per kg, and product B gives you the 5 rupees, it requires 5 kg of material, so 20 divided by 5, it comes to be 4 rupees. So what you notice is apparently product B looks to be more profitable, but when you take into account the key factor, when you take into account that material is limited supply, I would say the product A is more profitable. Hence, product A would be more profitable, keeping in view the limiting factor. And limiting factor in our example is this material supply. You have limited material supply. Another important aspect in the marginal costing is to find out cost indifference point, right? So let's understand what is this cost indifference point. That level of output where the total cost or the profit of the 2 alternates are equal. What is cost or indifference? Cost indifference is, I'm saying, is the output where the total cost of or the profit of the 2 alternates are equal. Means when you produce A or you produce B, there are 2 alternates, right? So the cost and the profit of the 2 alternates are equal. The calculation of cost indifference point helps in identifying the alternative which is more profitable for a given level of output or sales. A machine with a lower fixed cost and a higher variable cost per unit is more profitable when actual sales are below the point of cost indifference. This is important, friends, right? And a machine with a lower fixed cost and a higher variable cost per unit, as I just said, is more profitable when sales are below the point of indifference curve. So this is important. So cost indifference point in terms of units is difference in fixed cost divided by difference in contribution per unit. right? So in this way you can find out the cost in difference. The difference, the formula is difference in fixed cost divided by difference in contribution per unit. So cost in difference in terms of rupees means if you want to calculate in terms of units, you will simply say change in fixed cost and the divide by change in contribution per unit. And if you want to calculate in terms of rupees, you will say change in fixed cost divided by change in PV ratio. So this is called cost. In this way you can find out cost in difference point. That is in terms of rupees, change in fixed cost divided by change in PV ratio. Or in terms of units, you may say change in fixed cost divided by change in contribution per unit, right? So now after discussing this, let's take some practical example of marginal costing and break-even analysis, right? So I'm taking very simple example because so that you can have a feel of the different basic concepts of this marginal costing. That is how you calculate PV ratio, how you take business decision making. Like I'm starting with a very simple example so that the concepts become clear to you. So calculate PV ratio in each of the following cases. Means that in this example I have taken 3 different cases, and in all these 3 different cases we have to find out the PV ratio. As you know, as we have discussed in our previous lecture on the marginal costing, the PV ratio is also known as CS ratio. CS ratio means contribution to sales ratio. And what is contribution? This concept, friends, you should be very clear in your mind that what contribution means. Contribution is sales minus variable cost. Out of the total sales which your firm is making, if you deduct the variable cost, that is called your contribution. Or you must remember this equation: sales minus variable cost is equal to fixed cost plus profit. So the contribution, either I call it sales minus variable cost is contribution, or if I say fixed cost plus profit is contribution, is one and the same thing, right? So if in a business, if your fixed cost is 8,600, your sales is 25,200 and your profit is 4,000 rupees, you are asked to calculate PV ratio. So PV ratio, as I just said, is equal to contribution divided by sales, right? So it is known as CS ratio. So contribution, what is contribution? Our first objective is to find out contribution. So contribution is here 8,600, your fixed cost plus profit, right? 4,000 rupees. So fixed cost plus profit is your, because see, I said sales minus variable cost is contribution. So when you deduct the variable cost out of sales, what you get? What is the remaining? Remaining thing is some component of fixed cost and some component of profit. So profit and fixed cost is also constitutes contribution. In our example, the variable cost is not given. So what is given is, we are given fixed cost, we are given profit. So if you add profit in the fixed cost, you get contribution. So 8,600 plus 4,000, this is your contribution, and sales is given in our example. Sales is 25,200. So 8,600 plus 4,000, that comes to be 12,600. 12,600 divided by 25,200, that comes to be 50%, right? So in this example, the PV ratio is 50%. Once you understand the concept of contribution clearly, very clearly in your mind, it will be easy for you to find out the PV ratio. If you are asked to calculate PV ratio, variable cost ratio is 70%. You are given that variable cost ratio is 70%. You have to find out PV ratio. We know that if the variable cost ratio is 70%, sales minus variable cost is contribution. So what is remaining? 30% is your contribution, right? So very simple, 1 minus variable cost ratio is your contribution or PV ratio, right? So in the total sales which you make, the variable cost portion is 70%. Variable cost ratio is, what is remaining? Remaining is 30%. So 1 minus variable cost ratio is your contribution ratio. So 30% is contribution. The third case may be selling price is 50, marginal cost is 40. Whether I called marginal cost or whether I call variable cost, same thing. So if the selling price is 50 rupees, your variable cost is 40 rupees, What it means? Your contribution is 10 rupees, right? So what is PV ratio? Contribution divided by sales. So contribution here in our example is rupees 10. Means if we deduct variable cost or marginal cost out of our selling price, what we get is contribution. So contribution divided by your sales is equal to PV ratio. So 40 divided by 50, right? So that, or into 100, you right, for percentage purpose, that comes to be 20%. So in this way you calculate PV ratio. The three examples, the three different situations we have taken, in all these three situations we have calculated PV ratio. Let's take another example. PV ratio is such an important ratio because with the help of the PV ratio you find out the other things. So almost in most of the examples which I will be taking here in my discussion, I will be first calculating PV ratio and then I will come to the other points. Suppose in this fixed expenses is 2000 rupees. Break-even point is 10,000 rupees. Calculate PV ratio. Calculate profit when sales are 30,000. New break-even point if selling price is reduced by 10%. So there are three different aspects which you have to find out. First, we have to find out PV ratio. The other is we have to find out profit when sales are, means if the firm is selling 30,000 rupees worth of sales, what is the profit, right? And if a firm reduces its selling price by 10%, what will be the impact on the break-even point? This means where the break-even point will be, you have to find out. And what you are given is, you are given break-even point and you are given the fixed expenses. You should be very clear in mind that what is break-even point. Break-even point is the point where total cost is equivalent to total sales. What it implies is, if the fixed expenses is 2000 rupees, it obviously means your break-even point is 10,000 rupees. It means your marginal cost or your variable cost must have been 8,000 rupees, right? So these calculations we must understand by understanding the concept that we are given the, you may say, sir, variable cost is not given. So how will find out? We can find out what is the variable cost, since we know the break-even point means the point where the total cost is equal to total revenues. So at break-even point the revenues are 10,000, so it means so is the cost, and the cost is 10,000, it means fixed cost component is given 2,000. So the remaining portion is your variable cost. The remaining portion is 8,000 rupees, that is your variable cost. So PV ratio is equal to contribution divided by sales. So at break-even point, contribution margin is equal to fixed cost, right? So 2,000 rupees divided by 10,000 rupees into 100, that comes to be 20%. So 20% is your PV ratio. When sales are 30,000, right? So what is the means you find out when the firm is making a sales of 30,000, what is the profit you are earning? See, in marginal costing, profit is being calculated on the basis of contribution margin, right? So we know the contribution margin percentage is 20%. What is CS ratio? Contribution to sales, that at each level of sales, what is the contribution percentage, right? So if your firm is selling 30,000 rupees worth of goods, your contribution is 20% of 30,000. 20% we have already calculated PV ratio. So 20% of 30,000 comes to be 6,000. And what is profit? Profit is contribution minus fixed cost, right? So your contribution is 6,000, your fixed cost is given in an example 2,000, the remaining portion is 4,000. So it means our answer is that if the firm is selling goods worth 30,000 rupees, the profit at this level will be 4,000 rupees. How we have calculated? The step number 1, we have calculated contribution margin. Since we know the CS ratio, we will know what is the contribution. So sales into contribution percentage, that gives you contribution margin. So contribution, from the contribution, if we deduct fixed cost, because contribution sales minus variable cost is equal to fixed cost plus profit. So contribution minus fixed cost is profit. So contribution is made of two things, fixed cost and profit. So if you deduct fixed cost component from the contribution, the remaining portion is profit only. So at 30,000 sales, your profit is 4,000 rupees. Now the third aspect in this example is that if the selling price is reduced by 10%, right, what will be the new break-even point? So if the selling price is reduced by 10%, means if the firm was selling goods for 30,000 rupees and if you reduce the selling price by 10%, it means 10% of 30,000 comes to be 3,000. So 30,000 minus 3,000 comes to be 27,000. So new sales level is 27,000. Your variable cost is 80%. Since your contribution margin is 20%, it means your variable cost portion is 80%. We have just calculated the CS ratio 20%. So 30,000 into 80%, because we are calculating this variable cost on the basis of the original sales. It is the reduction in the prices. When you reduce the price, it is not going to impact your variable cost. So the variable cost, friends, I am calculating on the basis of my original sales. My original sales is 30,000. So 80% of 30,000, 80% is variable cost is given. We have just calculated, we have just seen, right? So 80% of 30,000 comes to be 24,000 rupees, right? So the contribution margins as per the new sales is 27,000 minus 24,000, because variable cost we have found out 24,000. Our new selling price or new sales level is 27,000. So 27,000 minus 24,000, this contribution comes to be the 3,000 rupees. So our new PV ratio will be 3,000 divided by 27,000. Now I will not take 30,000 because we have already reduced the price by 10%. So 3,000 divided by 27,000 into 100, that comes to be 11.11. That is this PV ratio. Earlier our PV ratio was 20%. Now our PV ratio is 11.11. This is the impact of reduction in prices. While I was talking of the uses of break-even analysis, I said if you want to earn a desired level of profit, you can find out with the help of the break-even analysis. If you want to know that what is the impact of the change in the selling prices, right, this you can know with the help of the break-even analysis. So in this example, we have find out the new break-even point, that is 11.11%. So sorry, PV ratio is 11.11%. So with the help of this new PV ratio, we can find out this new break-even point. So this new break-even point is equal to fixed cost 2,000 rupees divided by our PV ratio, that is 11.11%. That comes to be 18,000 rupees. So friends, this new break-even point is 18,000 rupees. So these are the three different situations which we have dealt in this. We have calculated break-even point, we have calculated the sales in order to have a desired profit, right? When sales are 30,000, what will be the profit? And we have calculated the new break-even point if we deduct the prices. And finally, let me take very simple example, one more example to conclude. The sales is 60,000 rupees. Your variable cost is 30,000 rupees. Your fixed cost is 15,000 rupees, right? So from this information, calculate PV ratio, calculate break-even point. BEP means break-even point. Calculate margin of safety. This new point has come, means we will calculating margin of safety. So very first thing is PV ratio. How do you calculate PV ratio? Contribution to sales. As we have been discussing in our earlier examples also, contribution is equal to sales minus variable cost. So if the sales is 60,000 and your variable cost is 30,000, your contribution is 30,000 rupees. So contribution divided by sales. So 30,000, right? Your 30,000 is the contribution. So your what is your PV ratio? So contribution divided by sales, 30,000 divided by 60,000 comes to be 50%. That is, if I multiply by 100, it comes in order to find out the percentage. So your PV ratio is 50%. And what is break-even point? The formula of the break-even point is fixed cost divided by PV ratio. Fixed cost in our example is 15,000 rupees. So 15,000 divided by 50%. That comes to be 30,000 rupees. So your break-even point is 30,000 rupees. And thirdly, in this question, ask about this example, ask about margin of safety. Friends, what is margin of safety? Margin of safety is the difference between the current level of sales and the break-even sales. So in our example, it is given that our break-even, our sales is 60,000, and we have just calculated that our break-even point or break-even sales is 30,000 rupees. So margin of safety is equal to sales minus break even point, right? So 60,000 minus 30,000 is equal to 30,000 rupees. So your margin of safety is 30,000. What is this? Again, let me tell you what is this margin of safety reflects. That is how much we are above the break even point. Every entrepreneur would like to know that what is the margin. Suppose there is a tough competition in the business, or there is a challenging, the business is in the downward cycle, means the industry is in the downward cycle. You would always under the fear that you should make a sale which is above the break even point. What is the margin? Suppose you want to increase the price, and you know it that when you increase the price there is going to affect the sales. So at this situation, before taking a decision of increase in the price, you would like to know what is our margin of safety level. Because of this change in the price, even if sales fall, right? So to what extent even if our sales decline, we will have at least break even point, right? So this margin of safety, larger is the margin of safety, the better it is for the business. So this margin of safety reflects that to what extent the sales is above the break even point. So with this discussion, friends, I am concluding here. So we have discussed that by taking different practical examples, we have discussed how we calculate PV ratio, how we calculate the desired level of profit, how we find out the margin of safety, and different concepts of key factor, the limiting factor, right? These are the issues which were discussed in this very lecture. Thank you very much.